Hi, this is George. In this video, we are going to see about monthly Banknifty Straddle or Ironfly with adjustments. Before getting into the video, please do subscribe to this channel and join our Telegram channel for instant updates. And also please like the video if you like the video. Let's get into the strategy. So this is a very basic strategy in option selling, as because mainly the capital required for this is just 50,000. So for beginners who doesn't know what's a straddle is nothing but selling naked ATM call and put. And this becomes an iron fly when you buy protection on both the sides. That is buying OTM call and OTM put. Here what we are going to do is we are going to sell ATM call and put, and we are going to buy for OTM call and put with a strike price difference of 1000 points from where we have sold. Say for example, if you are selling 39,000 PE and CE, we will be buying 38,000 put and 40,000 call for protection, which makes the straddle into an iron fly. In this, I have done manual backtesting for the last 6 months of Banknifty straddles. I'll show you the results in the upcoming slides. In this, hardly only one adjustment we are making, so it is very suitable for working professions and part-time traders, so that you need not spend the entire amount of time in the marketing portal. Disclaimer: this is only for educational purposes. Please do your own research before taking any trade. This is not a recommendation, but just my view. So let's get into the core of the strategy. So entry. So when are we going to enter into this trade? Say suppose there are we'll be entering at the second or third week expiry day, which is Thursday for the previous month at 3 p.m. Say for example, if a month is having 4 expiries, let me just say February month has 4 expiries. So for the month of March, if you're doing, we'll be seeing the previous month how many expiries are there. So here there are 4 expiries. So we'll be entering in the second expiry Thursday, which is 10th Thursday 3 p.m. Say suppose if you want to do for January, we'll be entering in the month of December, and December has 5 expiry days, which is it's 2nd, 9th, 16th, 23rd and 30th. In this case, we'll be entering in the third week Thursday, which is 16th Thursday at 3 p.m. So that is our entry. See, that is what I have given here. For January, we'll be entering on December 16th, and for February, the second Thursday, which as because there will be only 4 Thursdays. And when we are closing our position is when our our MTM shows minus 5,000 loss, we'll be booking loss, or we'll be booking profit when we are getting 5,000 profit. If we are not getting any of these, we'll be exiting on the expiry day of the current month at 3 p.m. Actually, this has not happened for the last 6 months that I have checked. It will either a profit will come or loss will come. So we need not wait till the end of the month expiry. Let's get into the adjustment rules. So we will be after entering into the trade, we will monitor the trade only at 9:30 a.m. every day. That is after entering at 3 p.m. on a Thursday, from the very next day, every day at 9:30 a.m. only we'll be checking the market. And if the market is based on the where market is at that time only, we will see whether we need an adjustment or not. We will do adjustments only when the break even gets breached on either side. So only if a break even is getting breached, we will be doing adjustment, or else we'll just wait for the next day. So what is the adjustment that we are going to do? We book the profitable sold leg and sell another leg on the same side. Let me just give you an example. Say suppose break even is breaching in the downside, which is say suppose break even is at 38,200, and if it is getting breached, then as because market is going in the downside, we will be booking profit in the CE side. CE side, the premium that we sold would have come into profitable zone. So that CE leg we are selling, we are booking the profit, that is we are buying back, and we are selling another CE leg. Now which strike price CE leg which we are going to sell, that is again the next thing that we need to know. So we'll be we sell either ATM call option. Say suppose here it is breaching at maybe 38,200. Say suppose it is at 38,200, then we'll be we can either sell 38,200 call option, or we'll be selling, say suppose if market is gapping down by 1,000 point or something like that. Say if it is going to 37,300, 37,500, in those cases we either sell at 37,500 ATM call, or we'll be selling the bought hedged call leg. So here we have already bought a put leg and call leg for protection, right? So in this case, we have a 37,300 and 38,000 put option we have bought. But we have to sell either 37,300, which is the ATM call option, or 38,000 call option, which is like for hedged position, the 39,000 is there. So we either choose 37,300 or 38,000 call option. So how we are going to choose is based on the strike price, which is nearer to the other leg which is sold. So we have the other leg as 39,000, that is a sold call and put initially. So if you see like which is nearer to 39,000, either it is which is like 37,300 or 38,000. We know like 38,000 is the one which is closest to 39,000. So we will be selling 38,000 call option and not the 37,300 call option. Let me give you an example of the last 2 months so that I can show you the live example which will make you familiar with the strategy. So for the month of March, I've taken, this is March expiry 31 of March. So for that second week of February, we are taking 10th of February. I've taken the time at 3 p.m. Market is at 39,000. So we are going to sell 39,000 both call and put. And we are going to buy 38,000 put and 40,000 call. Now you will see the payoff graph to be something like this, and we are going to monitor every day at 9:30 a.m. So very next day we are seeing that market has breached our break even and has went down. So this was the example I was showing that time without showing the real example. I was just illustrating this. So here you can see like 37,300 will be the ATM call option. So either we first we will book the profitable leg, which is the profitable leg, which is the call option. So we have sold at 1271 and we are booking profit at 600 rupees. So we are getting good profit of 16,000, somewhere around that. Now we have to sell a call leg. That call leg will be either this 37,300 ATM call option, or here we have the hedged portion is 38,000 put. So for which is nearer to 39,000. So we can see like 37,300 is far from 39,000, whereas 38,000 is near to 39,000. So in this case, we are going to sell 38,000 call option. So once 38,000 call option is sold, we'll see our payoff chart to be like this. Now with only that adjustment, we'll be seeing whether we'll get a profit or loss. I'll just see how it goes by. So by 25th of February only we got profit of 6,000. So we'll be booking it in profit. So for the month of March expiry, the one that we started in month of February second week, we are ending in profit. So we'll be booking the profit and we are done for the month. Similarly, I'll show you for one more month, which is like maybe for February expiry, we'll be entering in second week of January, as January has only 4 expiries. Let's see where the market is at 3 p.m. So market is somewhere around 38,400. So we'll be 38,500. We'll say just take everything as in multiples of 500, because bank nifty will not be so much liquid in the next month. So it is always better to have multiples of 500. So 38,500 call and put we are selling, and 37,500 put we are buying, and 39,500 call we are buying. After that, our payoff chart will be like, looking like this, and we'll start monitoring by 9:30 of every day. We'll see when the market is breaking our break even. Okay, on 21st of January, it has breached the downside again. So we'll be booking profit on the call side, which is at 840. Now we need to sell one more call option, we have to sell either 37,300 or 37,500. So in this case, 37,500 is near to 38,500. So we'll be selling 37,500 call option. Now let us see where market is going. So once we do that adjustment also, we'll have a very good width of profitable zone. See, we are at 37,300 or 400 and our break even is still 38,700. But as Bank Nifty moves so wide, we can end up in profit or loss. But that is the reason we are like selling little lesser premium one of a call option than more premium, because in that way our profitable zone will decrease if we are selling 37,300 call option than 37,500 call. Now we are almost breaching our break even actually. That is, we are getting into the loss of 5,000. If suppose we are going to the loss of 5,000, yes, we reached our loss of 5,000. So we'll be booking loss for the month of February. So that is how it has went. I have given the last 6 months of backtested data. You can see, like as I showed you, March was in profit and Feb was in loss. And other 4 months, out of 4 months, 3 were in profit and 1 was in loss. So overall, if you see the summary, out of 6 months, 4 were in profit, which is almost 67 months, 67% of profitable months. And overall profit is 10,000. And average profit or loss per month is 1,660, around that. And return on investment is like 1,600 by 50,000, which is almost 3,000. That is per month, which is a very good return. So this is a very good return for the less capital. And this is also a very simple strategy that you need not spend so much time on. So these are all the basic strategies that we'll be covering in the initial time, so that once we are familiar with that, then we can get into the complex strategies. So please do subscribe to this channel for getting more updates. And we have a few other videos like Nifty straddles, triangles and all in the channel. If you want, you can check those as well. Thank you.